Good afternoon or good evening, folks. My name is Charles Sells. I am the founder of the PIP Group. We invest in distressed real estate on behalf of our investors. I have the honor tonight of being joined with Matt Sorensen, who is a best-selling author with respect to self-directed IRAs. A lot of people don't even know what a self-direct IRA is, so this is going to be very informative for you as we get into the details of what Matt has to share with us tonight. So let's go ahead and get started right away, and we'll let Matt get the floor here in just a minute.
All right, Charles. Well, thanks so much. I appreciate the opportunity to be here, and I mostly appreciate being able to be here talking about my favorite topic, which is self-directed IRA. And let me know if you can see my screen now.
Okay, I'll pass you the screen in just a second. My computer's been a little squirrely today, so it's moving a little slow. But let me just give a quick shameless plug about the PIP Group. On behalf of the PIP Group clients, we provide double-digit returns investing in distressed real estate. We provide high-yield, collateralized, conservative investments for investors. And why we have Matt here, as far as the PIP Group is concerned, is SDRAs are another level of comfort, if you will, for investors because there's so much compliance that's involved with it. So probably 40% of our investors are SDIRA clients with one custodian or another. So we provide real passive turnkey solutions, making complex investments simple for our investors. And for many of the attendees tonight, some of you are clients. As you know, I took over this company about a year ago, and in doing so, we've made a lot of changes. One of those biggest changes is that we really want to educate investors. We believe that the more knowledgeable the investor, the more profitable the investor, and thus the more profitable we're going to be. So everything we provide as far as webinars or broadcasts or anything that you can find is always going to be free to an investor or prospect. So always keep that in mind when we refer a webinar that you might find online or point you in that direction. So what we invest in are tax liens and tax deeds, hybrid liens, which all of this we can't really get into detail tonight because this is Matt's show. But what we're going to do is, at the very end of this, we're going to show you how, as a passive turnkey investor using your self-directed IRA, these are the kind of returns that we're providing our investors today. One thing we do, on the previous slide I said real results. Anything we provide in a broadcast is going to be within a few months time frame. So we're not giving you the best of the best. We're giving you what's happening in real time right now. So we're investing in tax distressed real estate. We're also investing in regular, as I call it, regular mortgage, distressed real estate, foreclosures, that sort of thing. So we'll walk you through very quickly at the end of this broadcast how we get 24% profit in redeemed liens in the state of Illinois, and how we're getting 33.6% profit per year on a property down the street here in Savannah, Georgia. I'm in Hilton Head Island, South Carolina, but this one is actually just around the corner from us, and we'll actually show you how that happens. Again, all our education and our lessons are free. We go into all the details of each one of these types of investments on our website. You can access it anytime you want, but it's always there for you, so go take a look. Another biggie Matt will discuss is that the SDRAs are essentially owned by the custodian. So what makes us attractive to both you as the investor as well as the custodian is that you always retain 100% control of your investment. That means if you're investing, through an IRA, your investment is going to be John Smith, custodian for the benefit of John Smith, account number, yada, yada, yada. So that's how your investments are always going to be. So no funds are ever pooled or done through a fund or anything, or a REIT or anything like that. It's your investment, and that's the only way that we can comply with SDRA custodians, which Matt, I imagine, will get into as well as we move forward. So with that, I would like to introduce you guys to Matt Sorensen, author of the Self-Directed IRA Handbook. He has structured over 1,000 self-directed IRA investments, and he's a partner at a law firm, and forgive me, Matt, I can't remember which state you're in, but a lot of legal experience, and I can tell you from being in the SDIRA arena for the last 15 years, Matt has rapidly and very quickly made a very strong, good name for himself, and really has the wherewithal with regards to using an SDIRA in any form of investment. So with that, Matt, I'm going to pass the screen over to you, and the show is yours, my friend.
All right. Well, thanks so much. I appreciate the opportunity to be here, and just let me know that you can see my screen. I just want to make sure it's coming through great on your end.
So far, it's still my screen. Let's try this again. Okay, should be your screen now.
All right.
There we go.
All right. I might have got some fancy slides here. I want to make sure everybody sees those. So that's what I was really getting at there. Well, I love talking about this topic. As Charles mentioned, I'm known as a national expert in this area on self-directed IRAs. And what we're going to do here is talk about the basics of a self-directed IRA, really try and let you know if you're going to use a self-directed IRA, how it can be used, and then what's important as you're going in and making actual investments. Now, before I get too far, I'm an attorney, so I got to take my own advice here and just give a disclaimer. Keep in mind this is meant to be educational in nature, and this presentation doesn't constitute an attorney-client relationship. Seek out licensed professionals when conducting actual transactions. All right, I am a partner at KKOS Lawyers. As Charles mentioned, I am actually in our Phoenix, Arizona office. We have an office in Utah as well as one in Southern California. I also teach for the Retirement Industry Trust Association. That's the national association that represents the self-directed IRA industry. All the major self-directed IRA custodians out there are members of RITA. I teach for their institute. I teach at all their annual conferences. My book is part of their curriculum. So I'm pretty heavily involved with RITA, which has really been the major source of information for the industry and all the self-directed IRA companies. I hold my own self-directed IRA summit once a year. It's here in Scottsdale, Arizona. I've had hundreds of attendees attend live in person and through a live stream webcast of the conference. And that's a full day of using self-directed IRAs and going through strategies, what works, what you can, what you can't do. And then, of course, my book, which is what I'm most known for, the Self-Directed IRA Handbook. It's an Amazon bestseller, sold over 15,000 copies. It's used by most companies in the self-directed IRA industry. As I mentioned before, it's also a curriculum textbook for RITA, the association, when they do certification for employees in the industry. So pretty much this is what I spend most of my time doing. I've been working in this field for 11 years now, and really love actually working in this field because it's nice to see clients be able to have control in their investments and find success in investing in what they know. And that's really what self-directed retirement accounts are about. A lot of times when I speak, people are like, why are we talking about self-directed IRAs? And why is this a big deal? Well, there's $25 trillion in retirement accounts in the United States right now. And that number just blows my mind. I can't believe there's $25 trillion in retirement accounts in the United States. This is the one place where there's the most investable cash for Americans, period. There's no other place where Americans are more likely to have investable cash than in a retirement account. And I think as a lot of people think about this, their own money, people they know, and they think, oh, I need $100,000 for an investment, or I want to make an investment with $100,000. It's more likely they've got that money in a retirement account than they've got in their own personal savings or investment account. They may have some equity in real estate or things like that, or like a business with value, but they don't have cash. And so it's pretty interesting that people haven't learned how this money can be used. And that's what I want to talk about today is how does this money get invested in stuff that people really want to invest in, like trust deeds or note lending or buying actual real estate. How do people actually invest in that and not just buy stocks, bonds, and mutual funds? And that's what we're going to go over today. There's 25 trillion out there. It's estimated that there's about 200 billion in self-directed IRAs right now, So they're a very small sliver of the $25 trillion market. But it's grown, I'd say every 3 years, the industry has likely doubled. It's been on a major growth spurt over the last 10 years. Now, there's been a lot of press about self-directed IRAs, mostly about successful investors who have used self-directed IRAs in startup companies or tech companies. So Mitt Romney in the last presidential cycle had a reported IRA of $100 million. What he was doing is using an IRA to invest in companies he was consulting on at Bain Capital, which was Bain Consulting, their consulting company, and they were investing through Bain Capital. Many people there were using IRAs to invest in these companies that they really believed in and had a consulting relationship with. And they were basically investing in what they knew. They had a competitive advantage, and that's how he got a IRA reportedly at a value of $100 million. He wasn't just buying stocks, bonds, or mutual funds, just kind of in the market, so to speak. He was investing competitively at stuff he had a competitive advantage on. Peter Thiel, PayPal founder and CEO, he reportedly has a $900 million Roth IRA. That's right, $900 million Roth IRA. He was the first outside investor in Facebook, which he used his Roth IRA to invest in. This was back when only college kids knew about it, and it used to be called The Facebook, and there was like 25 people that worked there. Obviously now we know the success story, but so that was another one that's got a lot of press attention, is Peter Thiel's self-directed IRA. There's been others, the Yelp founder and chairman. Ones you don't hear about, but that I see with clients is, I have clients with $10 million plus IRAs and 401ks that are just doing real estate. And they're not high-name people owning publicly traded companies, so you don't hear about them in the press. But they're out there. And there's people investing $100,000, $50,000 with self-directed IRAs. So there's a lot of activity going out there. For sophisticated people like the ones here that have kind of been in the news, they've figured it out. But it's also everyday investors that put away a couple $100,000 that are finally realizing, oh my gosh, I don't just have to buy mutual funds, because most people don't even know what a good mutual fund is. Now I want to just talk about what a self-directed IRA is and what a self-directed IRA custodian is. So a self-directed IRA is there's no legal or technical term, there's no IRS distinction for a self-directed IRA. What self-directed simply means is it's an IRA that can invest in any investment allowed by law. See, when someone has an IRA with Merrill Lynch or Fidelity or something like that, and they say, all right, Merrill Lynch, I want to go buy a rental property down the street, or I want to invest in a trust deed note or something like that, they're going to say, nah, you can't do that. And it's not because IRAs can't own those investments, it's because Merrill Lynch won't let you own them. Merrill Lynch sells financial products. They want to sell you what they own, what they have. They don't want to go through the hassle of helping you buy a note or a tax lien or real estate or something like that. It's more work for them. So they don't allow you to do it. And that's how most of the financial services industry is. They don't want to let you buy those assets because it's more work for them, and they don't sell it. That's really the bottom line. Now what's happened is there's probably 30 plus self-directed IRA custodians out there who are companies that say, all right, if you have an IRA with us, we will let you invest in real estate or a note or a tax lien or in a private company, or whatever you want, as long as it's allowed by law. They'll let you invest in those types of assets. So the trick is making sure if someone wants to self-direct, and if you're thinking, God, I'd want to do this with my own IRA, you're going to have to change custodians. So if you're at Fidelity, you're going to have to close your account at Fidelity and move your funds, or at least move the portion of funds, to the new self-directed IRA custodian. It's kind of like going from Merrill Lynch to Charles Schwab. You're just changing companies. It's the same account type. If you have a traditional IRA at one place, you're going to have a traditional self-directed IRA at the next. Or if it's a Roth IRA, you're going to have a self-directed Roth IRA at the self-directed custodian. So there's no tax consequence to move accounts or to move to a self-directed IRA custodian. Now, what self-directed IRA custodians are, in order to custody an IRA, you must have a third-party custodian. And the law says a third-party custodian must be a bank, a credit union, or a state chartered trust company. Most of the self-directed IRA companies out there are trust companies, and so they qualify to serve as custodian. They send annual reporting to the IRS on your IRA, and all income, expenses, investments must be held by the IRA and ran through that IRA account. And we'll go through those some more detail on that shortly. In terms of picking an IRA custodian, there's lots of them out there. I work with almost all of them in the industry. There's a membership list for RITA, which is the Retirement Industry Trust Association, there on the slides. And so if you go to RITA's website, that's a good place to go. That's the National Association for the Industry. They have a membership list if you're looking for a self-directed IRA custodian. All right, now when it gets into what can you invest in with a self-directed IRA, there's really not a lot of restrictions, surprisingly. We're going to talk about a couple rules and pitfall areas, but in terms of what can you own with an IRA, there's only 3 restrictions. First, collectible items. The first restriction, you cannot own collectible items as an investment with a self-directed IRA. What happened when retirement plans first came around is Congress allowed you to actually own collectibles as long as they could be considered an investment. So people owned like artwork and stamp collections and coin collections and antique cars and stuff, and they were owning this in their retirement account. And there was some abuse of it, so the IRS came back and said, you know what, this isn't working. Congress ended up changing the rule, and sometimes, seriously, what was happening is there was wine collections that people own with their IRA, and those wine collections turned into bottle collections. And there was just too much abuse of collectible items because they do have some personal attachment to them, and they're not straight investments. So they restricted collectible items. Next was life insurance. I don't think most people are looking to own life insurance with an IRA, and that's exempt. I'll just move on. And then the third restriction is S corporation stock. Self-directed IRAs can own LLCs, limited partnerships, C corporations, but it's actually an S corporation shareholder rule. An IRA does not qualify as an S corporation shareholder. S corporations must be owned by individuals or something called a Q sub, which is a wholly owned S corporation that owns another S corporation. So in essence, an IRA doesn't qualify, so you can't own S corporation stock. Now, there are 2 things, though, to know, and that's what we're going to focus on today when investing with a self-directed IRA. And the first big item is something called the prohibited transaction rules. Now, this doesn't really restrict what you can or cannot buy. This restricts whom your IRA can transact with. Who can your IRA buy or sell assets to? Or can it buy a property and rent to? Or can it pay a service or a commission fee to? That's what we're going to talk about with the prohibited transaction rules, and that'll be the first restriction. Now, before I talk about that, I just want to outline one note here, which is how an actual IRA invests or owns something. So here I just have a simple rental property. This could be any type of investment. It could be a tax lien, a note, ownership in another company, but the basics here is you have someone who owns the IRA. Let's say this is Matt Sorensen here. This is my IRA. Now the name of this is going to be named after my IRA custodian, FBO Matt Sorensen. So if the self-directed IRA company that I move my money to is called, ABC Trust Company, then my IRA is going to be called ABC Trust Company, FBO Matt Sorensen IRA. And FBO means for and in behalf of. So everything is owned not by me, it's by my IRA. That's an important distinction you have to understand when you're investing in your self-directed IRA. This isn't you investing. It's your IRA, and I think people get confused by that, but it's not you. Everything must be done in your IRA's name. So if my IRA buys a rental property, for example, the purchase contract to buy the property would be in my IRA's name. If there's earnest money that needs to be paid, my IRA would pay it. The funds to close on the property at closing, those will be paid from my IRA. When there's rental income, the rental income goes to my self-directed IRA and it's deposited in my IRA account. When there's expenses, I authorize them to be paid out of my IRA account. So this isn't me owning the asset. I own the IRA, but my IRA is owning the asset, buys it, holds it in its name. So title to this property here would be an ABC Trust Company FBO Matt Sorensen IRA. It would not be in the name of simply Matt Sorensen. That would be wrong. So you'll have this self-directed IRA custodian. They're kind of an interface here. There's an LLC option where instead of having an IRA own the property, you can have your IRA own an LLC. Your LLC then owns the property or other investment. And I'll show how that works a little bit later on here. But this is the basics of how the general self-directed IRA structure works. All right, now I mentioned the main restriction is called the prohibited transaction rules. The other thing we're going to talk about is something called UBIT tax. This is a UBIT or UBTI tax. This is a tax that sometimes applies to IRAs. But the first thing to understand is what's called the prohibited transaction rules. And essentially, this is a law that was created by Congress that restricts retirement accounts from transacting with certain people. So when Congress created retirement accounts, they knew that these were tax-favored accounts. These are, they're tax-deferred if it's a traditional IRA, or they're totally tax-free if it's a Roth IRA. So they said, we need to put some restrictions on this. We don't want people to abuse these types of accounts and just move all their other assets they personally own into it and then sell them all out of their IRA. And we don't want people abusing their retirement account and just sucking money out for their own personal use or benefit. We want them to invest this money. So they created these rules called the prohibited transaction rules. And it restricts your IRA from transacting with yourself, with your family members, certain family members. We'll go over who's restricted. And then it also restricts you or any of your family members from financially benefiting or using the assets that the retirement plan is invested into. So there's 3 variations of how these prohibited transaction rules arise. I'll go through each one here in the next few slides. But no matter what type of prohibited transaction you have, whether it's any of these 3 per se, extension of credit or self-dealing, and we'll go through each of those. But no matter what type of prohibited transaction you have, the IRA is going to be deemed disqualified. It's distributed entirely. You no longer have that IRA. And so if you're under 59 and a half, you got a 10% early withdrawal penalty. You're going to have to take all that money into income and pay taxes on it. And then you have to start claiming income from that investment personally rather than letting it build up tax-free or tax-deferred in your retirement account. So we want to avoid prohibited transactions because you lose the IRA if you have one. All right, now let's talk about the first type of prohibited transaction, which is called a per se prohibited transaction. And a per se prohibited transaction is actually pretty easy because it happens whenever you have an IRA engage in a transaction with a disqualified person. Now, transactions defined there, it's purchase, sell, lease. Really, anytime money is going in and out of the IRA, that's going to be a transaction. And the second part to that is whenever that IRA is transacting with a disqualified person, then we have a per se prohibited transaction. So you need to know who is a disqualified person. Well, the list includes the owner of the IRA themselves, their spouse, their kids, their parents, and also any companies that they own 50% or more of between the IRA owner and these disqualified family members. So the trick really is knowing, is my IRA transacting with the disqualified person or not? So for example, if my father owned a note in his personal name and he wanted to sell that note, and I said, all right, I want to buy that note with my IRA, that wouldn't work. That would be a per se prohibited transaction because now I'd have my IRA purchasing, which is a transaction, from a disqualified person, which would be my father. Now, if I change the facts a little bit, though, and I said, all right, what if that same note was instead owned by my sister or my uncle? And let's say they were selling the note, and I wanted my IRA to buy it. Now we have an IRA purchasing the note. That's a transaction, but it's not a disqualified person. Siblings are not on the disqualified person list. Neither is your uncle. And so that would not be a prohibited transaction. That would be okay. My IRA could buy the note or the property or the tax lien or whatever it may be from my father or my sister, from my sister or my uncle, because sister and uncle are not disqualified persons. Now here's the list here. This is outlined a lot more in detail in my book, The Self-Directed IRA Handbook. I have an entire chapter, by the way, on each different variation of these prohibited transactions I'm going to talk about here. So I'm going to just be hitting the high points because we don't have a lot of time. But a couple things to note here is you know the family members here, siblings are not disqualified. Also, one thing that's tricky is when you go up the family line, you only pick up ancestors. That's like your own ancestors. When you go down the family line, disqualified people, think of you as the account owner, and then think of your siblings, they're disqualified. Also, spouses of children are disqualified. So your son-in-law, daughter-in-law, your IRA can't transact with them either. Now, when you go up your family line, your parents are disqualified, your grandparents are disqualified. Your parent-in-laws are not, though. So your mother-in-law and father-in-law, I mean, your IRA could transact with your mother-in-law. Mine's never going to, but you could, right? They're not on the list here. You only have to pick up ancestors when you go up the family line. So sometimes people will generically say, oh, family members are disqualified to your IRA. You can't transact with family members. Well, it depends on where they are in the family. You got to be a little more specific. You can't just rule out all family. All right, the next type of prohibited transaction is called an extension of credit prohibited transaction. And an extension of credit prohibited transaction occurs whenever you have a disqualified person. Remember, think of IRA owner, spouse, kids, parent. Whenever you have a disqualified person, extend credit to an IRA. This mostly comes up with IRAs that buy real estate. So you can have an IRA that buys real estate and you can get a loan too to leverage the purchasing power of the IRA. So you could get a loan. However, the IRA and the owner of the IRA cannot guarantee that loan. If the IRA owner, who's a disqualified person, remember, if the IRA owner guarantees the loan that their IRA obtained, that causes this extension of credit prohibited transaction, because now we have a disqualified person extending credit from themselves to their IRA. So if there was a loan being done, IRA is the buyer on the property, and the owner signs a personal guarantee, that would cause this extension of credit prohibited transaction. What's happened based on this rule is there's been a small little industry of what's called non-recourse loans for IRAs. There's about 3 or 4 banks that really work. There's 3 banks that really work in this area mostly, and they will provide what are called non-recourse loans to an IRA buying property. What they essentially do is they say, you know, in the event of default, we agree not to go after the IRA or the IRA owner, but we're going to foreclose and take the property back. And because of that remedy, they make you have, you know, about 30 to 40% down on the property. It has to be income producing. You know, they're going to make sure there's enough value there that if they do have to foreclose because of non-payment, that they'll be able to avoid any losses. So, so you can get a non-recourse loan. You can leverage the purchasing power. Just keep in mind it's going to require more money down, and the owner of the account cannot guarantee the loan. So if you're ever getting a loan with the IRA, make sure you're being careful and using a bank or lender who's familiar with the IRA rules and restrictions. Now, there is also a tax that can apply when you leverage your retirement account. Basically what they do is they apportion the income you make on a deal. If you put in like 40% IRA, let's say you buy a property for 100 grand, 40,000 of that's the IRA's money, 60,000 of that is the loan that you get. The IRS is going to tax the profits from the loan. So if 60% of that investment is debt, it's not retirement plan money, the funds came from a loan, they're going to tax that portion of profits, so 60% of that deal if it's 60% leveraged with debt. We might be able to talk a little bit more about this later. I have some slides later on, but just keep in mind whenever you leverage your retirement account with debt, it can cause tax from the profits attributable to debt. If you always buy investments with your IRA and you're buying with the IRA's cash, you don't need to stress about this. It's just when you leverage with debt that you run into these 2 issues. Okay, the last variation of prohibited transactions is called a self-dealing prohibited transaction. And this one's the one that's very subjective. The other ones are very easy to identify because it just meets a definition. But self-dealing, sometimes called conflict of interest, is a little more subjective. And what it is a self-dealing prohibited transaction occurs whenever you have an IRA or an IRA owner or other disqualified person who benefits from the IRA's investment. So for example, let's say that my IRA makes an investment. It buys a trust deed or it buys a piece of real estate, and I get a commission personally. Maybe I'm a real estate agent or something. I get a commission for my IRA making that investment, the buyer's agent commission. Well, that would be a prohibited transaction because I'm personally a disqualified person to my own IRA. If I receive a commission, I'm now personally benefiting from my IRA's investment by receiving compensation. So you have to avoid any compensation or commission or salary or any income you may personally make from your IRA's investment. Obviously, the IRA can make as much money as it can. I mean, it should try and make the best investments it can and maximize its returns. But the IRA owner personally can't be getting, money on the side or a commission or salary or other income if it's the IRA making the investment. Other example would be, let's say that you have a rental property, the IRA owns a rental, or even you loaned money on someone else's real estate, so you have a note. You can't go stay or have use of that property. I have some clients that have a vacation rental property their IRA owns, and they say, well, no one's going to stay there 1 week. I didn't get it rented. Can I just go stay there with my family? No, that would be self-dealing because you're a disqualified person, and by staying at the property, you're personally benefiting from your retirement account's assets. So the bottom line, you can't have use of the assets owned by your retirement account, you nor any disqualified persons. All right, now the next item I just want to show is a pretty common structure used by self-directed IRA investors, particularly in the real estate realm, whether it's private lending or rental properties or properties being flipped. Some investors will use something called an IRA LLC. And what this is rather than an IRA buying real estate directly, and the rental income being paid, and you directing your custodian to pay an expense and to sign a lease with that person, and you're doing all this back and forth between you and your custodian when your IRA owns something directly. Rather than that process, a lot of people in real estate in particular will use an LLC, and instead of their IRA owning property, the IRA is going to own an LLC, in this case 100%. The LLC in turn is going to own the investment. And this could be a note, a tax lien, property that's a rental or a flip, doesn't matter. And the LLC can have multiple assets. Now the LLC is just going to be an LLC, typically set up in the state where you're buying properties or making investments. The owner of the IRA can be manager of the LLC. You don't have any personal ownership of the LLC. Your IRA owns it 100%. But you can be manager of the LLC. Manager of an LLC is like president of the corporation. The manager is the one who can sign for the LLC and make decisions. So as manager of the LLC now, if the LLC wants to buy a property, the buyer on the purchase contract for a property will be ABC Investments LLC, or whatever you decide to call the LLC. And then the signer of that contract for the property will be the IRA owner who signs as the manager of the LLC. And now the LLC is under contract. They'll have a bank account for the LLC, where the IRA is going to invest the money. So once you have the self-directed IRA set up, and then you have an IRA LLC set up that meets the compliance requirements for the custodian, they'll cut a check from the IRA written to the LLC, let's say ABC Investments LLC, and then that LLC in turn goes out and purchases the property. And the LLC will have a bank account wherever you want to bank. It's just a regular LLC checking account. And as manager, you'd have the ability to sign checks, to send funds or send wires as needed to make investments. Now in this structure here, we have the IRA owning the LLC 100%. It's a disregarded entity for tax purposes, so the IRS does not require a tax return. You'll just have to keep the LLC active in the state. Which means typically just paying some fees to the state to keep it active. And then you report back to your IRA custodian every year to say, all right, here's what I own in the LLC now. I've got a note for 100,000, a property for 250, and a bank account with 20. And you add those up and say, here's the value of the LLC. Report that back to your custodian every year so they can update your account. Now, you can have a lot of different variations on this LLC. We can have 2 IRAs on the LLC. We can have IRAs and individuals owning the LLC. Sometimes you have a husband and IRA, wife IRA, and they own 50-50 of an LLC or 60-40 or whatever it is. And if we ever have multiple accounts that own one LLC, we're going to break up the ownership of that LLC based on the dollars invested. So there's a lot of variations of this IRA LLC. This one's the most common, where it's just one IRA that owns it 100%. It's frankly the easiest and most streamlined. But you can have a lot of different variations that this LLC could be set up to combine multiple sources of funds if you needed to do so to make a particular investment. These are some of the things I talked about. If you're a manager of your own IRA LLC, you have to be very careful to make sure you don't cause a prohibited transaction. There's a few custodians in the self-directed IRA industry who will not let you be manager of the IRA LLC. There's about 30 self-directed IRA companies out there now. I'd say about 25 of them allow you to be manager, subject to restrictions in the documents. But there's about 5 that won't let you be the manager because they're worried you're going to use the bank account, and operate it improperly. So, but as long as you operate a property that's a legitimate structure, we set up a lot of IRA LLCs in our office. Our fee for an IRA LLC like this is $800 plus the state filing fees. We do all the documents. They're very unique to IRA rules, so the operating agreement and subscription documents are pretty unique. The tax ID, how you obtain it's a little different. It's just a little different process than a regular LLC. So if you're familiar with the regular LLC you may use in your other investments, the IRA LLC's got its own set of tweaks to it because of the IRA rules. And it's going to go through compliance at the IRA custodian to make sure all the IRA provisions and issues have been addressed in the documents. And they'll review that before they fund it and allow the IRA to invest in it. Now, what you cannot do if you're manager of the IRA LLC is you can't pay yourself a salary, or you can't do physical work on assets the IRA owns. So if your IRA LLC buys a property to fix and flip, you can visit the property, tell people what to do, but you physically, as a disqualified person, you physically cannot do the work. You can't go put on the tool belt and remodel the kitchen. The LLC could hire a third-party contractor to do work, and you can be there to make sure it's being done as manager, but you can't do actual physical work. And again, nor can you pay yourself a salary. There was a case a few years back called Ellis versus Commissioner that involved an IRA LLC. Ellis's IRA was the owner, and he was paying himself a salary for serving as manager of the LLC, and that was deemed to be a prohibited transaction, which was kind of an obvious situation, but there is actually a case about it now. So, okay. Now I know that's a big topic right there, and I'm trying to just get this information out to you. Hopefully it's digestible. We're going to come back for questions. So if you got some questions on the prohibited transaction rules that we just hit, we're going to come back to those here at the end. I just want to hit the second area, which is a little shorter actually, but I want to hit the second area where we can have issues with self-directed IRAs. So in 99% of self-directed IRAs investments, the 2 issues that have to be considered, besides regular investment issues like due diligence and just analyzing the investment, but for self-directed IRA specific investments, there's always 2 issues. Is there a prohibited transaction, what we just talked about? And then and on that question, if there is a prohibited transaction, you just don't do it. You can't do the investment at all because you'd lose the account and there's bad penalties. So you just don't do the investment if there's a prohibited transaction. The second issue, though, is called UBIT, Unrelated Business Income Tax, sometimes called Unrelated Business Taxable Income. It's really the same thing. It's like tomato, tomato. But UBIT tax is a tax that can apply to an IRA's investment. Now, if you have UBIT tax, that doesn't mean your IRA cannot invest. That just means the income your IRA is making is you're going to have to pay tax on it, which, as we know for IRAs, you generally can make income in an IRA and you don't have to pay tax on it. So, if I had Apple stock that I bought $100 a share and I sold it for $150 a share in my IRA, I've got a $50 gain, but I don't have to pay tax on that gain because my IRA owned it. Same thing, let's say I had a note that I invested $100,000 in and I sold it for $120,000. Now I have a $20,000 gain. That goes back into my IRA. There's no tax on the gain. Or if I have a property that's generating rental income, or I've got an interest income scenario, all that income is building back up in the IRA. You're not paying tax on it because you're getting that retirement plan tax deferred or tax-free treatment, depending on whether you have a traditional or a Roth. Now, UBIT is the exception to that rule, though. Again, the normal rule is you're not paying tax on the income your IRA is making unless you have this UBIT tax. Now, UBIT tax is basically a tax that applies when an IRA has business income. See, when Congress created IRAs, they said, we want to incentivize people to invest with IRAs. And so we want IRAs to receive investment income, like capital gain income, interest income, rental income, dividend income. That stuff's all investment income. And if that's what you're getting in your IRA, you're fine. You don't need to worry about UBIT. UBIT's not, there's no UBIT on that type of income. So investment income is good. Business income, though, causes this unrelated business income tax for IRAs. And generally where we see this most for IRAs is two scenarios. The first is if your IRA invests into an ordinary income business, such as an LLC, that's maybe a restaurant, or an LLC startup tech company that does not pay corporate tax. Now what happens there is that's a business, so it's business income, and the business passes on their tax down to the owners in like an LLC, for example, and that's going to cause UBIT for an IRA. Now if the business is a C corporation, let's say your IRA invests in a restaurant that's a C corp, or a startup tech company that's a C corp, and you start getting dividend income from the C corp, that's actually exempt from this UBIT tax because the company has to pay a corporate tax on the money before they pay out the dividend. So the IRS gives you an exemption from UBIT tax in that scenario. So the first catch would be your IRA is invested into an ordinary income business, ordinary income being selling of goods and services typically, and that company doesn't pay corporate tax. It's a flow-through type tax entity like an LLC or maybe even a limited partnership. Now the second area where this UBIT tax can arise is in real estate development, construction, or short-term flipping. Real estate's probably the probably the number one investment asset for self-directed investors, whether it's owning property directly for rent, owning a property that's being flipped, or owning a note on a property. Those are some of the most common investments that you can have from a self-directed IRA. And if the income you're generating is rental income, capital gain income when you sell the property, interest income if you've got a note on a property, that stuff's all fine. That's going to be investment income. But if you have real estate development type income, or you're doing construction that you're building properties with the retirement account and selling, or you're doing a lot of short-term flipping with an IRA, meaning your IRA is flipping more than a couple properties a year, then what happens is in these scenarios, the IRA is deemed to be in the business of real estate as opposed to investing in real estate, and it causes this UBIT tax for the IRA. So that's UBIT tax. Those are, again, the two areas where it typically applies. Here's the exemptions I mentioned. These are what are always exempt. If you're getting this type of income in an IRA, don't worry about UBIT. Interest income, whether it's a tax lien, a trust deed note, any type of promissory note, an interest arrangement, dividend income, like REITs get dividend income, C corporations, if you're buying stock on the stock exchange, those are all dividend income type companies, they're exempt. Royalty income, this can be mineral rights, intellectual property, those types of incomes can generate, even some oil and gas stuff generates royalty income, that's exempt. Rental income for real estate is exempt, and capital gain income when you sell an asset for a profit. Those are all exempt from UBIT. I mentioned this UDFI before. This is if you leverage a property with debt. It'll cause a tax called UDFI tax. If someone has some questions, we can come back and address that. But the basics of that is, again, if I bought a property for 100 grand, let's say I sold it a year later for 130,000, And at the time I bought it, I put $40,000 down for my IRA. $60,000 came from a loan. Let's say at the time of sale, my debt had been paid down to about 50 grand. Here's basically a calculation of how it runs. Now, this is the basics. I'm not trying to make you be an expert. I thought maybe I should just take this slide out because we did call this the basics. But the bottom line, what's really important to know is if you're using debt to leverage an IRA's investment, you got to know two things. First, the debt must be non-recourse, meaning you're not signing a guarantee or using your credit. And then second, the portion of the investment that is the debt's money, the IRA is going to have to pay tax on profits that it gets from the debt. The portion of the investment that represents the retirement account's cash, that goes back to the retirement account, no tax. And there's ways you calculate that. This is chapter 15 in my book that goes through the actual calculations. And I do have a toolkit on my website, the Self-Directed Investor Toolkit, with some webinars that's free on my website that you can get that also goes into more detail on UDFI. So Charles, I wanted to come back to you. I know there were some questions you already had that people had posed, and we may have some already in here, and see where you want me to go with it from here.
Yeah, absolutely, Matt. Can you hear me? Can you hear me, Matt?
Yep, I can hear you.
Okay, all right, great. Okay, so your broad, like my broadcast of tax liens, it's so much information that it's like a deer caught in the headlights. So the questions do come through a little slow, but once we start asking them, we get more.
Yeah.
So we'll start asking some questions, and maybe we'll do some additional broadcasts in the future because it is a lot of information, but it's very valuable information. And you know, like I said, I've been working with IRA custodians for 15 years, and this is I've learned something here tonight just with the UBIT stuff. So let's get to the questions. The first question is with regards to compliance, and it's about gold. And the question essentially is somebody that wants to invest in gold using their SDIRA, can they put that gold in the custodian's name in a local like a local safety deposit box at their local branch?
Okay, yeah, that's a good question. I've written a blog article and an extensive white paper on storage requirements for precious metals. So I've got a lot more resources on this. The Wall Street Journal actually did an article on this subject probably 2 or 3 weeks ago. I actually talked to the Wall Street Journal author or emailed her about it, and some of the other people that were involved in providing information. But in terms of the home storage, that's what it was about. And we can talk about the safe deposit box too. But if you own precious metals, see, self-directed IRAs can own so many different things, and you can own precious metals. Like you can own real gold or real silver or real platinum or real palladium. There's these types of metals that qualify that your IRA can own. And we're not talking about your IRA owns a fund somewhere else that says they have precious metals. We're talking about you own this actual gold coin or this actual piece of bullion, this actual bar of gold. You own that exact piece with your retirement account. And so you can do that. There's always 2 criteria when you buy precious metals. You have to meet two criteria. The first is it must qualify, be a qualifying precious metal. And this is, by the way, chapter 9 in my book. But qualifying precious metals include platinum, silver, palladium, and gold. And those 4 types of metals, you have to meet certain purity requirements. Each of those different metals has a different purity requirement. And but then there's also specifically approved coins like American Eagle coins that are gold or silver that qualify as well. So the first criteria is make sure that the specific precious metal you're buying qualifies. The second is you have to make sure that the precious metal is properly stored. So when they allowed precious metals to be owned by retirement accounts, they put a restriction in there in terms of storage. And they said you must store precious metals with a quote-unquote bank. And a bank under the rule is defined in the tax code as a bank, a credit union, or a state-chartered trust company. So you could store your metals with any of those three places. Now, if you buy precious metals with your self-directed IRA, most of the custodians are going to say, we have a relationship with XYZ Depository, and we're going to send your metals there. Your metals will be there, and you'll have storage fees there, and but that's kind of the general process with most self-directed IRA custodians. Now, to this question, you could move those metals to somewhere else if you have a bank that you want to store them at. But you're going to have to get special permission from your custodian to allow that, because generally they're going to want the metals to go where they send all their customers' metals. It's easier for them to track and send it, and if you ever sell it or have questions about it, they all know it's all at one place. So for IRS rules, yes, that could work. You could have it at a local bank stored there, but your custodian's probably not going to allow that because they don't want to, they don't want to have 100 different relationships with local banks for their thousands of clients.
Right, it becomes
So,
an administrative issue.
right. And the other item, though, is you could do what's called an IRA LLC that I talked about earlier and have the LLC buy the metals, and then the LLC goes and sets up a safe deposit box at a bank and stores the metals there. We've looked at that before and believe that would qualify. So there are a couple options on that. If you go to my website, I do have a lot of resources on precious metals and the storage issue because the Wall Street Journal did an article basically saying you can't store them at your home. There's a lot of companies out there advertising storing precious metals at your home, and you could do it. And so the Wall Street Journal did an article, the IRS commented on it, and the IRS basically said, no, you can't store your precious metals that your IRA owns at your home.
Right. Okay. Now, for those of us that are used to the lingo in this business, is the IRA LLC the same thing as what we often refer to as a checkbook IRA?
Yes. Yeah, we like to call it an IRA LLC because it's not just a checkbook.
Right.
It's an actual LLC. But yeah, it's the same thing.
Okay. All right. So, and then the next question I have from Craig is, if I own my company and have a self-administered 401k, can it be the custodian for my self-directed investments?
Okay, yes. So there is something called a solo 401k that's pretty common among self-directed investors. And as I mentioned at the beginning, IRAs, you must have a third-party custodian for an IRA. However, solo 401ks, you can have, if you're self-employed, you can establish your own 401k for yourself through your own business, and that 401k can invest just like any other 401k type of retirement account. It could own real estate or other investments. And you can be trustee of your own 401k. The 401k rules don't require a third-party custodian. So I actually had a slide about this back here, which is the solo 401k. I kind of skipped it before we got to the end there, but I was seeing if there was going to be questions or interest on the solo 401k. It looks like there is. So you can have your own 401k. You don't have to have a third-party custodian, but you have to be self-employed. So you have to have your own business. Generally, it works best if you don't have other employees in that business. It's just you, or maybe you and a spouse, or you and family, because then you can set up a really aggressive 401k for yourself, move over assets and other retirement accounts to it. That 401k, you can have a checkbook directly out of the 401k to make investments. You don't need a third-party custodian. You can self-trustee it, and it works pretty well. I actually use a 401k myself. We have a law firm 401k, so it's a little different than the solo 401k I'm talking about here. But it's absolutely does become very popular for people who are self-employed. That self-direct is to use this solo 401k.
Okay. And then before I jump to my slides, what is the maximum of sources, and I'm guessing a maximum of the IRA, that you can put in one transaction? I think I know the answer to this question, but I'll let you take that.
Well, I mean, you can do as many transactions as you want, and you can have as much money in the transactions from the IRA. There's no restriction on investment returns or how much money can be in an IRA. Now there's restrictions on how much you can contribute each year to retirement accounts. So there's contribution restrictions on like building up and starting a retirement account. You can put in $5,500 a year in an IRA. In the solo 401k here, you can put in $53,000 a year. So in terms of just putting money into the account, the contributions, there's restrictions on that. But investment returns, you can, that's, like I said, there's a $900 million Roth IRA out there. There's lots of people with $1 million accounts. They're getting good returns and being good at making investments. And that's how they've grown the account.
All right, then I got one that's kind of off the wall, but it does make sense because we've got some recognizable names as clients as well. But the anonymity of using a SDIRA.
Yeah, generally your IRA is going to be, if you invest directly out of the IRA, the name of your IRA will be on the actual investment documents, whether it's a deed or a tax lien or whatever it may be. So that could be publicly available. It'll say ABC Trust Company, FBO, Matt Sorensen IRA. One solution to that's just using the LLC that I mentioned earlier. So now the LLC owns the investment, and the LLC could just be ABC Investments LLC. You could set up the LLC in a state that's has good privacy protection, like Wyoming, where you don't have to list owners or names, or even the manager name on public documents. So that might be a good alternative for someone that has privacy issues or anonymity issues. And I've had that myself. I have a client that's a Grammy award-winning musical artist that is very concerned about that. And then we just have other people that are not necessarily high profile, but otherwise have privacy issues and just want they just don't want their name out on everything. So the LLC can be a good solution to that. But not every state's the same on that, so you want to make sure you're setting up in a state that you can keep your name off of it in terms of the ownership records.
Right. Okay. And then this one actually includes us, so I will definitely get to this one. You mentioned flipping being something that could become taxable. What if PIP Group is doing the flipping? I assume then it is a passive investment and it's okay.
Well, it's everything an IRA invests in is passive, because
Right.
IRAs don't do anything but put cash in. So the question is, what's the type of income the IRA is receiving? So if you're investing into flips, that's okay. You want to make sure you're being careful on how many flips your IRA is investing into and receiving profits on. So our general rule of thumb is if it's a couple of flips a year, you don't need to stress about this. If your IRA is getting profits on, and when we say flips, we mean a property that's been owned less than a year. So any of those, if you do a couple of those a year, I wouldn't worry about this because you're just not doing enough to be deemed in the business. If it's 3 or 4, you could be, there's other factors, and this issue of being invested as one partner in it with other people, that can help. If you're doing 5 or more, you definitely want to be talking to an attorney or CPA to make sure that you're not going to be subject to UBIT tax. So that's a little bit of a nuanced answer, but that's unfortunately how the tax is. That's the best guideline I can give, though.
Right. Okay. All right. I'm going to. We're running over, so I'm going to jump back to our slides. Mine will take just a couple of minutes to run through. We'll try to entertain a few more questions, and then we'll let you guys wrap up. I know some of you have dinner or dessert to go to, and those of you on the West Coast have to get into your 3-hour commute moving at 8 miles an hour. So I know you're in a rush to get there. So let's get back to the slides real quick. As I mentioned, we provide good returns, and about 40% of our clients are SDIRA investors. One of the things we provide, one of the more popular investments for our investors, and maybe it's because of the UBIT situation, are tax liens in the state of Illinois. And the reason that they're so popular is because for the past, I guess 10 years now, our purchase rate on tax liens in the state of Illinois has exceeded 24% per year. what I'm showing you here is a tax lien certificate as well as a redemption report. Very quickly, as you can see, this lien was purchased in February of 2014. It was bought at the maximum rate of 18%. In the state of Illinois, that doubles every 6 months. So the actual return on investment here was 108% on this particular lien. The caveat being there that we have to pick the right liens to make sure that they redeem in order for you to make these high percentages. And the one thing that we can't confirm, guarantee, or have the crystal ball for is what will redeem and what won't. We do a lot of due diligence to try to determine what that is, but we can't guarantee. We obviously don't guarantee that particular return. So we do a lot of tax lien investments in the state of Illinois. We cover, out of the 107 counties, we cover about 96 of those. Our investments begin in, well, it says next month, but day after tomorrow essentially is the kickoff of what we call investor season. Our minimum investment in Illinois is $50,000. The purchase rate average, again, is 24%. Space is limited because we've had a lot of challenges the last couple of years. Hedge funds are in there spending money at 0%, literally 0%. The logic behind that, I don't have any. I do discuss it a little more in the Why We Like Illinois broadcast that you can get on our website. But space this year will be limited. We're capping how much we're willing to accept to go place in Illinois, and we're being ultra conservative in what we're purchasing this year. We also showed you at the very beginning this particular house. It looked a lot better. We purchased this in the state of Georgia for $5,000 at a hybrid tax deed sale. Essentially what that means is the tax deed that you buy at the sale acts as a lien for the first year. In the first year, it earns 20% return if redeemed. If it's not redeemed, you earn the right to foreclose on the property. So we purchased this particular one for $5,000, and many of you are saying, oh my goodness, what were you thinking? You paid $4,999 too much for that house. Well, that's why we're in this business, and that's why we're successful in this business. We did buy it for $5,000. It wasn't redeemed. We foreclosed on it for $4,200. The repairs were extensive, absolutely. We spent $27,000 on the property within the past 6 months, giving the total investment of $36,700. The duration of the investment was 2.5 years, so you're not going to be subject to that UBIT. The gross cash flow, the owner of this property is an IRA. They want to rent it out, so their cash flow on it is going to be 27.8% per year. What I want to highlight and point out is this duration of investment was 2.7 years. However, there was only $9,000 tied up in it for the first 2 years and a couple of months. Current value of the property, if they were to flip it, would be $70,000, conservatively $74,000, $75,000 if we were to actually list it. Giving a cash profit of $33,300 divided by the duration of 2.7 years, that's a 33.6% return. So that's how we're providing these great passive profits to our investors. We are investing in properties that are distressed. They are not necessarily properties that you and I would want to live in, but they are cash cows. It's what 95% of America right now can own. We are in the process of building a new program called HOPE, which stands for Home Ownership Preparation Experience, where we are essentially providing homes to people that couldn't qualify for a regular mortgage, and it's a win-win. There's huge profits both ways on those particular properties. I know this one kind of threw you guys a curveball, so let's make it a little more simple. Here's a fix and flip. Very standard fix and flip. We go to the auction. We bought it for $72,000. We bought it in March of this year. We put $37,000 into repairs on it. The total investment was $109,000. The duration of investment was 7 months. We just got it under contract for $173,500. We listed it for $184,900. And a lot of investors will say, well, why didn't you, milk it out a little bit more? Because we didn't have to. it's a heck of a good return for our client, for an SDIRA investor. The gross cash profit, you'll have to excuse my computer's freaking out now, um, was $64,500, giving a net profit, that's after our fees, that's after closing costs, that's after everything, of 26%, which gives you an annualized return of 45% on this particular investment. This one's pretty good. We are doing these all the time. That is not going to be our advertised return. We're doing well over 20% net annualized profits to our clients every day. I did not include the slide here, but we have just introduced a new 16% promise, which essentially means that if you're not making 16% annualized per year on your investments, you pay us nothing. So this is the type of things that IRA investors are doing with their self-direct IRAs. These are the type of things that you can do with your self-direct IRA as well. And I invite you to continue to listen to our broadcasts, our lessons. They're obviously in depth. A lot of what Matt has said, even though I've got a lot of experience, it's like it just blows over your head. So we'll try to get into more depth, more detail. I absolutely encourage you guys all to buy his book. I have, and there's a heck of a lot of information in there that I am catching up on as well. Before we close this out, I will go ahead and put Matt. I'll go ahead and put your information back up on the screen here, so everybody can get that information. But I thank everybody for your time and your attention, and we look forward to the next broadcast.
All right. Thanks, Charles. Appreciate being here.
Great. Thanks, Matt. Have a good night, everybody.